Imagine waking up one morning in late 2026 and realizing that everything you believed about modern stability was a comforting lie. Banks, markets, governments, currencies, everything that felt permanent suddenly feels fragile. Not in the dramatic overnight chaos of 2008, not in the sudden market implosion of 1929, but something slower, quieter, more deceptive. A collapse that doesn't start with a bang but with a whisper. A crisis that begins disguised as a normal correction, a simple slowdown, an easily ignored piece of economic news, until the entire global system starts to twist under its own weight. And what if the timeline isn't distant? What if the pressure point is not 2030, not someday in the future, but late 2026 into 2027? And what if the reasons this upcoming crisis will be worse than both 1929 and 2008 were set in motion decades ago? This is the story of the 2026 crisis built not from a single mistake, but from a collection of decisions layered over generations. A crisis created by governments, banks, corporations, and consumers who all believed the same myth, that growth could outrun risk forever. And like every myth, this one ends when reality demands payment. To understand why the 2026 crash looks inevitable, we need to go backwards far before the warning signs appeared. Because every major economic collapse begins long before the world notices. The Great Depression didn't start with one bad day on Wall Street. Its roots were in years of speculation, leverage, and blind optimism. The 2008 crisis didn't start with Lehman Brothers. It began decades earlier with policies, incentives, and financial products designed to hide risk rather than eliminate it. Likewise, the coming collapse didn't begin in 2026. It began with the idea that debt is harmless as long as everyone keeps pretending it isn't there. Around the world, governments spent beyond their limits. They borrowed, refinanced, shifted liabilities, and promised future growth that never arrived. The United States crossed $35 trillion in debt. Europe's welfare states continued expanding. Japan normalized having the highest debt-to-GDP ratio in recorded history. China built entire cities on borrowed capital and speculative real estate. Everyone assumed growth would outrun debt. But by the early 2020s, growth slowed. Debt didn't. And this imbalance is the quiet engine powering the coming crash. While governments buried themselves in obligations, the world created a new housing bubble bigger and more global than anything in 2008. Low interest rates between 2020 and 2024 ignited the largest housing surge in human history. Prices rose everywhere, from the United States to Canada, from Europe to Australia, from China to Southeast Asia. But when interest rates climbed in 2022 to 2025, the math changed overnight. Buyers stepped back. Sellers refused to lower prices. Markets didn't crash, they froze. And a frozen market is far more dangerous than a collapsing one, because it delays the correction until the underlying system becomes brittle. At the same time, corporations took on historic levels of cheap debt. They refinanced repeatedly, built expansions on loans, and pumped billions into stock buybacks to inflate share prices. But corporate debt doesn't stay cheap forever. Beginning in 2025 and accelerating into 2026 to 2027, trillions of dollars in corporate loans reach maturity at interest rates 2 to 3 times higher than the original terms. Companies will need to refinance at unbearable costs or drown. And then there's the illusion of recovery. Every slowdown of the early 2020s was met with the same playbook. Print money, lower rates, stimulate demand, and hope no one asks what happens when the world runs out of room to absorb the next shock. Policymakers began believing their own narrative that economic pain could be postponed indefinitely, that every downturn can be rescued, that central banks can bend reality, but illusions have limits. To see how the world sleepwalked toward this collapse, look at the calm years 2023 to 2025. Inflation cooled, markets rallied, tech soared. Governments celebrated a soft landing, but beneath that fragile optimism were warning signs few wanted to acknowledge. GDP rose, but real productivity stagnated. Corporate profits increased, but revenue didn't. Housing prices soared, but affordability collapsed. Governments collected less money while spending more. The numbers didn't match, yet analysts repeated the same comforting narrative. Everything is fine. By 2024, irresponsible financial behavior returned with full force. Leverage increased, risky derivatives resurfaced, meme assets surged. Venture capital fueled billion-dollar valuations for companies with no profit and little revenue. The world danced on a familiar cliff edge, pretending the fall no longer existed. But 2025 was when the cracks finally appeared. First, global consumer debt hit record levels. Defaults didn't explode, but they doubled. Not enough to alarm the public, yet more than enough to alarm analysts. Then commercial real estate failed to recover. Office buildings across major cities sat empty. Banks holding those loans posted subtle losses. Governments quietly raised taxes, not dramatically, but enough to signal they were running out of fiscal space. And global supply chains fractured again, not from a pandemic this time, but from geopolitics, tariffs, and rising transportation costs. These weren't isolated events. They formed a pattern. By the end of 2025, economists faced a terrifying realization. The world was running a 1929-style leverage bubble on top of a 2008-style credit bubble, wrapped inside a 1970s inflation structure, overlaying a 2020-style supply chain vulnerability all at the same time. Then comes the breaking point. The second half of 2026, the first domino begins quietly. Corporations begin refinancing their massive debt loads, only to discover that new interest rates make profitability nearly impossible. Many attempt to stall, hoping central banks cut rates. They don't. Corporate bankruptcies begin rising. Slowly at first, then rapidly. Investors reassure themselves it's normal, but the trend continues. The second domino is the housing market. Inventory rises, prices stop climbing, buyers vanish. Sellers panic. Mortgage-backed securities, reborn and rebranded since 2008, begin showing cracks. Early losses appear. Investors shrug. It's only temporary, they say, but the losses deepen. The third domino falls when major banks quietly report unexpected losses. Exactly the same phrasing used in 2006 and 2007. They increase provisions for bad loans. They warn of tightening liquidity. Their earnings miss expectations. But the public doesn't panic because the messaging is calm. Only insiders know how serious it is. The fourth domino is government reaction. Emergency meetings, temporary liquidity injections, policy announcements meant to reassure the public. But unlike 2008, governments are already drowning in debt. Their capacity to stop contagion is weaker than at any time in modern history. Then comes the spark, the black swan. Maybe a major bank collapses. Maybe a large country defaults. Maybe a geopolitical shock hits supply chains. Maybe a corporate giant fails. The exact trigger doesn't matter. A system is so fragile that almost anything can set off the cascade. Once markets realize the truth, the fall is rapid. Stock markets enter aggressive corrections. Analysts beg people to stay calm. Central banks issue updates. Politicians appear on camera. But none of it stops the decline. Indices drop 20 to 30% in months. Volatility explodes. Panic spreads. Credit markets freeze. This is the true point of no return. When credit stops flowing, companies cannot refinance. Workers cannot be paid. Loans cannot be renewed. Risk cannot be offloaded. And unlike 2008, there's no cavalry coming. Governments cannot slash rates enough to spark growth. Printing money risks igniting inflation. Stimulus becomes politically toxic. The world is trapped. The global economy contracts. Unemployment rises. Businesses close. Supply chains seize. Consumers stop spending. Demand collapses. Governments struggle to maintain order. The downturn becomes global, not an American crisis. Not a European crisis, but a worldwide rebalancing. Attempts to fix the collapse fail because the tools no longer work. Interest rates are too high to manipulate easily. Money printing risks currency crises. Countries refuse to cooperate. Social trust is already damaged. And algorithms amplify panic at speeds humans cannot comprehend. In 1929, fear spread by newspapers. In 2008, by television. In 2026, by social media in real time. History begins to repeat, but with new masks. Like 1929, the world is overconfident. Like 2008, risk is hidden inside complex financial structures. Like the 1970s, inflation returns in waves. Like 1999, tech euphoria blinds investors. Like 1987, algorithms magnify volatility. But unlike any previous crisis, all of these elements converge simultaneously. This is why the 2026 to 2027 collapse is projected to be worse than anything seen in a century. Because it is not one crisis, it is every crisis at once. A global system stretched beyond its limits, finally recoiling. 3 core truths emerge from this story. First, crashes don't begin with chaos, they begin with complacency. The real danger was never the downturn itself. It was the belief that downturns were impossible. Second, the world built an economy on temporary solutions: debt, stimulus, cheap credit, and those solutions eventually expire. They were never permanent fixes, only delays. Third, individuals who prepare early will suffer the least. Crashes destroy the unprepared and elevate those who recognize patterns before they become headlines. The story of the 2026 crash is not just a warning. It's a reminder. Every economic collapse exposes what was already broken. Every downturn reveals the risks we tried to bury. Every crisis forces a reset that should have happened long before. History doesn't repeat exactly, but it rhymes, and the rhyme is louder than ever. The real question isn't if the crisis is coming. It's who will be ready when it arrives. If this documentary opened your eyes and you want deeper breakdowns of the forces shaping the next decade, subscribe, share this video, and turn on notifications. The story of the 2026 crash has only begun, and you won't want to miss what happens next.